subtle shift in the time periods that you're looking at?
Again, Michael McGee with Townsend Group. I'm going to take you through the September 30 results, and I'm going to just focus today primarily on the market and then your compliance with your policy, which was approved in April 2010. So we're just coming up on the one-year anniversary of having implemented that new policy and moving the portfolio into a new position for a going forward basis. Generally, there's been some general improvements both within the market as well as within your portfolio, and so on a day-to-day basis, we're seeing real estate recover more slowly than the equity markets, but yet still having its own recovery. If I can get this to move. I'm not going to have you focus on that page. From a market overview, which is INV, well, and my holes are punched, so I think it's INV 17, let's see, 3 or 4? I can't see the numbers, so I'm sorry. My report, page 4. There's some key things to look at for real estate. The first one being transaction volume. It has been increasing. Chris made the comment about the fact that we have regular pricing issues and that real estate lags, and that is because of the appraisal process. Appraisals are generally done based on comparable transactions in the market, and we still remain very slow compared to historical levels, and particularly relative to the peak of the market. We are still at less, while it's improved in 2010, we are still 70% below the peak of 2007 as far as numbers of transactions that have been occurring. And we're going to talk in closed session about what that's meaning as far as the implications for your strategy and your investments as you go forward. There has been a flight to quality. This board represented a similar strategy shift. The tolerance for risk and the volatility in the asset class was really those that just didn't want to be opportunistic or could not take the volatility have moved towards the more core stabilized assets within the market, and that is having a negative impact on core pricing, meaning that that pricing is now chasing a lot of capital, chasing a very few number of deals coming to the market. And so that has implications as well for the investors that have tried to de-risk their portfolio. Again, we'll be talking a little bit that in closed session. Some concerns within the real estate portfolio. Net operating income and the assets are really what bases the price for any kind of real estate. And while we're seeing pricing recover, we aren't necessarily seeing net operating income recover. So what we've seen in the market through 2007, 2008 was rising rental rates, increasing occupancy, the ability to release easily, all with increasing net operating income at the asset. And that peak, that price to perfection moment that we hit when we hit the market collapse, has resulted in a number of assets with tenants and leases rolling where their new rental rates are going to be lower than what's in place. And that impacts the pricing as well as the go-forward performance of real estate in general. The cap rates, Alan referred earlier to, it's the inverse of the price-earnings ratio. They have been decreasing, which means prices have been coming back up, and we've seen a recovery in value. But it's been primarily in the primary major metropolitan areas where demand has been sustained, and also primarily within two property types, apartments, first of all, and also within retail. Retail has remained fairly stable and done very well within many of the portfolios. We expect that cap rate to compress even further and to see secondary markets, more tertiary markets where demand is not as great, to continue to improve as demand for real estate improves. And we've talked about the small increase in jobs that we've seen, and as the economy continues to improve, we should see real estate improve along with it. But at the end of the day, real estate is driven by jobs, and there is no such thing as a jobless recovery in real estate if we cannot put tenants in. And we'll talk about inflation a little bit when we have the closed session, but to just touch on it here, inflation in real estate can be your friend as long as there's demand for real estate. If we have inflation and the cost of doing business gets greater, you can put that onto your tenants. You can increase your rental rates as long as there's demand to sustain it. That means we need jobs to recover as well, so that that demand stays there, and so that consumers spend, and that products are shipped through our industrial, and then we'll talk. We can also, within the apartment area, we have the demographic demand behind it. That's really why apartments have recovered today much sooner than any other property type, because there is that baby boom. What's it called? The baby boom echo. Echo boomers who are coming up and hopefully for all of us moving out of our houses and taking up apartment space and unable to afford to purchase a home or qualify for a loan given the restrictions that are being given by the banks in today's residential market. We have been advising some of our clients, including CalSTRS, to invest in core through open-ended funds. There was a temporary opportunity in the marketplace to take those existing, an open-ended fund is much like a mutual fund. It's a pool of assets that exists today. You can purchase units in that fund, and you can continue to own those units or move in and out based on pricing. We have the open-ended funds as they priced their assets down, they overcorrected, and there was a very short opportunity to allocate capital into those pools of assets and arbitrage the recovery of the market. So that core recommendation has been made, and your staff has made allocations to some of the core open-ended funds where they felt that arbitrage existed, and that also to increase your core exposure. We expect distress to continue through 2011, and really the peak of the recovery is expected to be 2012, 2013, to be fewer distressed owners, and that's just a 50,000-foot market overview, and I'll take you into your particular portfolio. Did you have a question?
Yeah, I was going to just say, Ms. McGee, that the slides aren't coming up on the...
I wasn't going to, this is what I'm sorry, I'm talking off of this slide.
Okay.
And I didn't, because it's so many words, I didn't want to put it up there.
Okay, very good. Thank you.
We're going to go over this slide in detail in closed session, but in order to stay with the Open Information Act, I wanted to just reference it here. This is really just designed to be a typical market cycle. What I want to be able to talk to you about is the relative difference between returns in core value and opportunistic, and you can see the spreads and how they shift as we go through market cycles, appreciating environment and a depreciating environment, and we'll talk later about what that means to your portfolio strategically and where we are in that process. Oh, and those were supposed to not come in yet. Okay. For the CalSTRS portfolio, on INV, and I'm sorry, my report, page 6, INV 17 something, I can't read it, 176. We referenced earlier that in April 2010, you approved a new strategic plan. You changed the classifications of your assets and holdings to include core, value, opportunistic, and public, and as of today, we don't have any public securities in your portfolio. We changed your benchmark from the unlevered NCREIF index to the levered NCREIF fund indices, as well as the levered Odyssey, which is the open-end funds indices, again, to allow you to compare your levered portfolio to a leveraged benchmark. It would be very difficult in any market cycle to exceed an unlevered benchmark if you are levered. Well, on the way up you can, on the way down it's virtually impossible. You'll see in the middle of this page the policy portfolio that was approved. This reflects the board's desire to move more towards core, pushing towards a 50% allocation for core, 20 in value add, 30% in opportunistic, and 0 right now for public. We would change those weightings if we decided that public was appropriate within your real estate portfolio at a given time. We've completed a full analysis of your portfolio. Your staff has worked diligently, and we've had numerous conversations about the absolute risk and the relative risk of your various investments, and there's over 200 and some odd investment positions that had to be culled through and determined exactly where they should be classified based on these new groups and new style groups. That information's been given to your performance consultant, Private Edge, and they expect to generate a report at year end that will reflect those new classifications and allow us to compare you to the new benchmark. As of March 31st, we will have had all of your managers that could not be classified in one big portfolio. So they may have an asset that's a core as well as value as well as opportunistic. They will have separated those assets for a period of 1 year, beginning April 1st, 2010, when you adopted the strategy, through March 31st, and we'll be able to show you what your new strategy looks like for that first year relative to your newly adopted benchmarks with that March 31st report. As of September 30th, which, as Chris indicated, we do lag a quarter, you were $1.7 billion in real estate, which was under your 11% allocation to target. but your performance had outperformed the NCREIF index for the period 50 basis points on a gross of fee basis and 10 on a net of fee basis, which is your objective for the total portfolio historically. Showing your funding status, again, the 12.4 is for the first quarter of 2010, and in the third quarter of 2010, you were at 14.2. I'm sorry, 14.3 to your 15.9 target. So under your target, we've been very cautious in making additional allocations, and you have also been working hard to eliminate allocations where performance could not be guaranteed by additional capital being committed, and we'll talk a little bit about that as well in closed session. And then your investments that were made in first quarter of 2010 and then third quarter of 2010 as well. The value that you see there is reflective of the improvement in the market value as well as limited capital commitments to existing managers. From a portfolio performance perspective, your total return for the current quarter was 4.0 relative to the, on a net basis, relative to the NCREIF index of 3.9. There's the 10 basis points of excess return. And for the fourth quarter, your numbers just came in today. They are preliminary, but they generally don't shift. You will achieve a 5.8 net return compared to the 4.6 gross NPI. So again, outperforming the NPI, doing what we would hope you would do in a market recovery, and that's begin to move upward faster than the unlevered index. Now, when we move you to Odyssey, it may not look as good because it's a leveraged index, but it will be a reasonable risk-adjusted reflection. I'm going to briefly take you through compliance. No concerns with respect to your portfolio allocations. You are within your allocation targets. You are to be 30 to 70%. This is the old program, again, so the new policy doesn't apply at this period. And you are at 31.4% core and 68.6% tactical. Leverage has begun to be reduced, and while you have reduced your leverage in your tactical portion of your portfolio as well as in your core, your total portfolio is just barely over your 60% limit because of the overweighting you have to tactical, which by its nature has more leverage involved in it. So again, as we see core increase and tactical decrease, we should see that overall leverage come back within the restraints that we've established for the portfolio. This page just provides an analysis of your core portfolio relative to targets by property type and geographic region. I'm not going to spend a lot of time on this because this still, again, reflects the old classifications, and in those classifications you had both land as well as other top property types classified within your core portfolio, which would not normally be included. Your underallocation to industrial is something that we have been looking at with the staff to ensure that you increase that. It's one of the property types expected to recover quickly in this next market. And then that's really the 30,000-foot perspective. I can go into any details you have on the report that we gave, but that's our executive summary.
Thank you, Ms. McGee. Questions or comments from committee members? Ms. Rogers?
I think, Maitland, when you come and talk to us a whole bunch, we were waiting for the huge meltdown in commercial. Is this the huge meltdown in commercial? Have we experienced it? Has everybody stretched it out over a long period of time? Now, as the residential kind of experience has hit the floor, is doing what it's doing. There was always this discussion over the last 2 years that there's all this outstanding commercial and what it was going to do to the banks and so on. And our valuation is what it is, but I mean, in the bigger picture, do you think, has the commercial hit the floor? Are we going to slog along? Are we creating more mortgage and finance problems for the banks that are holding these mortgages? I mean, I keep getting the feeling there's not been this big boom in commercial being advertised in the financial press quite the way we initially heard it, but I'm just not sure if that's my own naivete in reading things, or it's being stretched out, or it's being refinanced, or the institutions, what's sort of the macro?
Sure. There was absolutely a major correction in the commercial market. We had about a 40 to 50% correction in valuations. The bottom's hard to project. I'd say we probably hit it sometime in 2010 as we have started to see a recovery. What, in real estate, the challenge has been the fact that usually when there's a massive market collapse, there's distress and, you know, what we fondly call blood on the street and opportunities to make huge investments.
Right.
And that did not occur in this market cycle, and that was absolutely driven by TALF and TARP and every other government program that allowed banks and borrowers to basically blend and extend and pretend, or whatever you want to call it.
Kick the can down the road.
And they were kicking the can. And so, and that's what we're talking about when we say that we're at 30% of our peak transaction volume. We aren't seeing that distress come to the marketplace in really big volumes. It's 1.3 trillion of distressed debt that needs to, CMBS that needs to be.
When our TARP and TELF and whatever disappears and we stop government spending and so on and so forth, do we end up with, I mean, that's what I guess what I was
With
saying.
another hit?
Is there a looming, we're going to dump a bunch of stuff, or does it continue to kick the can? What do you see?
The belief is that the banks have taken their hits and they've been given so much forbearance and ability to keep that on, to take the hit and keep it on their balance sheet and not be penalized for it. We're starting to hear about banks saying, we've got $1 billion we need to get off of our balance sheet in the next year. But they're not going to fire sell this stuff, because what we did in the 90s was the RTC, and
Right.
Resolution Trust just
Right.
dumped everything on the
I think
market, and the
that's what I meant by
taxpayers
this
lost
crash,
all that
which we
money.
which didn't occur.
Yeah. And it corrected very nicely, and there was a lot of distress, and there was great opportunity to get great returns in that recovery. We haven't seen that in this market, and we don't expect to. The government basically loaned money to the banks to hold them up. They used that money, and they're going to provide a return to the taxpayers by making sure that they hold those assets until they can sell them at a non-distressed value. That doesn't mean there's not distress in the marketplace. There is. It's just not anything we would have expected given the write-downs we had, and it's dribbling out. I'm fond of saying that it's going to be one of those market recoveries that we're going to look back 10 years from now and go, we recovered, that was fun. It's just not going to feel as good. It's going to be moderated returns going forward. It's going to be really about picking the right managers and the right strategies, given where you are in the market at that time and where capital is going. It's going to be very, and on that chart that I showed you briefly, we're going to talk about in closed session, very critical where your allocations go today, because it's not a normal distressed market that you can just, in the 90s, you could give money to virtually any investment bank, tell them to go do an opportunistic fund, and they knock the ball out of the park. And that's not available to us today. So it's taking a lot more oversight and caution, and we are using both of those
So
to
essentially
allocate
the can
capital.
is still being kicked down the road, but the
Yeah, I
road may
think,
not end.
yeah,
You
I
just-
equate it to
you'll
cutting
kind
the
of
dog's
wear it
tail
out.
off bit by
Okay.
bit. They're just not going to whack, they're not, but we'll get there. I know, poor dog. And so the upside's limited. I think that's the
Okay.
most important thing to understand is we're not going to see 20s and 30s coming out of this recovery, because we're not seeing the kind of distress in the sales that we need to have in order to get there. You have to be able to
And
price.
it was quite a conscious policy decision not to create another REIT after having been through, I mean, REIT, to create another.
RTC?
RTC, not REIT, yeah, RTC, to not create another one, to just
I'd
keep
like
this
to
thing
believe the
afloat.
government deliberately tried to do what was going to be best. It's hard to say
Maybe it just happened.
what would have happened. I mean, if they let it
Yeah,
collapse,
give
it
government
would have
some
recovered.
credit, it's okay. You can-
It would have recovered still. It would have been extremely painful, and it probably would have been much more detrimental to us. So yes, it's going to take longer to get all that worked through the system. I think somebody always uses the sausage through, or whatever it is.
You don't want to watch it being made.
You don't want to be, yeah, and this is going to be one of those processes where we're going to watch it getting made every
So
quarter,
Going back to my original
slowly.
question, this publicity around, we were going to have the big crash, the real estate and stuff on the market, that did indeed,
Happen.
it happened in price, but as far as the process of dumping stuff on the market, that was different.
Yeah,
Okay.
people have held those things. All you have to really do is look at your portfolio. You weren't forced to
Right, and
sell.
that's what I'm saying, I don't have this feeling.
And
I
there's
have
a
the
lot of
feeling that
people
the
like
value
you.
went down, but I don't have this feeling that there was this huge rush of stuff.
That's correct.
You know, the way we had this huge rush of houses, you know, we've had the whole place
Right, yeah, the difference
swamped with
being that when you,
foreclosed houses.
yeah, when you mortgage a residence, as long as you're paying your mortgage, they haven't been taking your house back.
Mm-hmm.
But the owners of real estate, they've been able to service their debt, even though their values have gone down. And if they haven't, the banks have taken them back, and the banks haven't dumped those on the market because they're waiting for prices to stabilize.
So as I understand, Ms. Rogers' initial line of questioning was along the lines of the commercial real estate overhang that remains, and it's been spoken about and written about. Is it Townsend's opinion that that's not a risk we need to be too concerned with at this point within our portfolio?
I believe, I'm not sure, I want to make sure I answer the question for what you're asking. And there is an overhang of assets that will come to the market from distressed owners. They will trickle out. That is a concern for your portfolio because as long as they only trickle out, pricing will still continue to be supported regardless of what's happening at the fundamentals. And so, yes, we are very cautious about what we purchase today. It does not impact the valuations of your existing portfolio. There's no double dip or expectations for major price adjustments as those hit the market again because they've all been marked to market or predominantly marked to market.
I have one additional question, but do other committee members have questions or comments at this point? I have a question relative to the credit markets. If you could just speak a little bit about where the credit markets are today relative to perhaps where they were 6 months ago or 12 months ago, and whether, if they have in fact shifted, does the shift in those markets create any types of risks that we should be concerned with?
We've seen an improvement, a significant improvement in the availability of debt. So banks are, once again, loaning on good commercial real estate, again, primarily in those primary markets, major markets, stabilized assets. And they're looking very closely at rent rolls and current market rates and all those rents and all those elements before they loan. We are also seeing a great deal of capital being raised in the debt space to provide debt that can't be provided by the banks. It's nowhere near where we were at the peak of the market. And important distinctions, and I think Alan even referenced this, are there's much more adherence to matching term of your hold for your asset to the term of your debt so you don't run refinancing risk. There are lower interest rates, so there's more gap between the service for the NOI on the asset and the ability to service that debt. There is less loan to value. So when you were buying assets in 07, 08, you could get a loan at 80, 90, or even sometimes 100% of the value of the asset. 65% seems to be the sweet spot right now, and that means a stabilized asset. And we're just now hearing about a few of the larger investment managers being able, through their established banking relationships, to be able to obtain debt on assets that have leasing risk. But that, by and large, is they won't even touch it. Banks won't loan on anything that has large turnover or vacancy or any kind of risk that the service for the debt would go away from a cash flow perspective. The challenge with leverage in today's market is that you are long-term holders, by and large, and you would be advantaged by placing leverage on your assets at very low risks and holding it for 10 years and the period of the hold of the asset, and that would be incremental to your returns as well as advantageous to selling the asset because you'd have advantageous debt that could be assumed or taken on by any owner. As interest rates rise, that would make your debt more attractive. So we're trying to manage that opportunity with the fact that we need to limit the leverage based on the policy that you have, so balancing all of those things.
Ms. Dillon.
Michaelin, I really appreciate your expanding on the comments that you already had written for us in your market overview. And I'm sure I saw you in the back when Carolyn was talking to Alan about having the executive review. I know when I'm out and about talking to our constituents, I think the vast majority that really ask about the portfolio are asking about real estate. So maybe moving forward, fleshing out your report a little bit more and putting an executive review in so that when our members go to our website and they read that, we can understand it in 5th grade, maybe 10th grade English, something like that. That would be much appreciated.
Probably not my 10th grader, but yes, okay.
Yeah, probably not mine either.
I'd be
Thanks
happy
very
to do
much.
that, yes.
Any other questions or comments from committee members? Seeing none, thank you, Ms. McGee. Thank you. Appreciate it. Thank you. Oh, because these are action items, Mr. Bartow, Mr. King, do we need a motion to adopt these reports?
No, they're just reports.
They're just reports. Okay. Thank you.
Staff recommendation was
Staff
to adopt,
recommendation,
yeah.
yeah.
Do you want a
Yeah.
motion, Harry?
No, I'll trust it. Okay, which brings us to item number 5 on the agenda, which is the private equity semi-annual performance. Mr. Mike Moy from PCA is with us. Welcome, Mr. Moy.
Thank you, Mr. Chairman. Mike Moy from PCA. In keeping with a comment I just received from staff, I will volunteer to give you an executive summary in the next one. So we will pass on that comment. Private equity trails or follows public equities. And private equity is an asset class that has a much longer life cycle than the public markets. So from an expectation perspective, you should be looking at what you've experienced in the public markets over a period of time, and you should feel like you are going to be earning that plus some sort of premium for the illiquidity that you suffer while you're in the private equity asset class. We attempt in the material that we've presented to focus you beyond the current period, because the current period really in private equity doesn't have significance from an ownership perspective. I went through and made some comparisons to what the numbers were 6 months ago, as well as to what the numbers mean or how they compare to your public equity experience. We would like to focus more on the 3, 5, and 10-year periods of time because we think that's more representative of what you're going to get out of private equity. And compared to your benchmark, you outperformed in the 5 and 10-year period of time, and you underperformed in the 3-year time period in the numbers that are presented here. When you look back to what the numbers were 6 months ago, your performance deteriorated by 50 basis points in the 3-year time period. They deteriorated by some 80 basis points in the 5-year time period. And in the 10-year time period, they improved by 50 basis points. So I would say, or I would argue, it is going along. I mean, there's going to always be ups and downs, but there's no major shifts. Your since inception performance has declined by 1 basis point from June 30 to December 31, or from March 31 to September 30 numbers. Compared to your public equities, private equity in the time period of December 31 outperformed each of the time periods, 3, 5, and 10 years. And in these 5 and 10 years, they outperformed by more than 300 basis points, which is the premium that you have in policy. So from a performance perspective, I think you're getting exactly what you wanted to get out of private equity. Some people would say, well, we'd want to see a higher premium, and there's debates out there whether that premium should be higher. The preponderance of evidence is that the majority of private equity investors seek a 300 basis point premium. They don't seek 500. 10 years ago, 15 years ago, they were looking for 500, but it's diminished. The efficiencies that are sort of the fundamentals for private equity, inefficiencies that are the fundamentals, I think those inefficiencies are going away. They're starting to move. We have a relatively sophisticated secondary market developing. We actually have a number of trading posts, so to speak, that act as intermediaries trying to place secondary offerings, which is, for a large investor such as yourselves, is an advantage. If you decide that you have too much exposure to a geography or a sector or a manager, you can effectively carve out a piece of what you have in your portfolio and sell it into the secondary market. And on this other side of it, if you wish to increase your exposure, you can go and attempt to buy it in the secondary market. So what didn't exist 10 years ago in terms of portfolio management is becoming much more common. 2009 and 10 were pretty bleak years for the private equity space in terms of distributions back from the managers and commitments by investors such as yourselves. In the fourth quarter of 2010, you all observed many transactions in the marketplace that were reported almost on a daily basis, lots of IPO activity. And as a result of that activity, the distributions back to investors such as yourselves escalated. And historically, when distributions come back from private equity managers, they are anticipating going back out on the fundraising trail, trying to get further commitments from you as an investor, and we are seeing that. Now, there is some evidence that in the first quarter of 2011, the level of commitments that were closed in 2011 wasn't as high as one of the prior reporting periods, but we, from just a scheduling perspective, we are seeing lots more managers out on the marketing trail trying to raise new funds. You can see back in sections of your report the levels of commitments that you have made and the numbers of commitments that you have made in the past 6 months, 9 months, has been pretty active. So there's been no, let's call it, no diminution in your activity in the space. You've been a pretty active investor. You typically get seats on the different funds that you represent or that you've invested in, so that it's a, I would just say the program is working the way it's supposed to. Now, there are some things in the marketplace that I think are potentially a problem. I know it goes back to this covenant light that Alan mentioned earlier. We are seeing a resumption of those much more quickly than I would have thought. It's almost, it's baffling to me, having gone through the period of time we went with credit and the absolute disappearance of any credit, and then all of a sudden, within a very brief time period, we're seeing covenant light loans being made again. We're seeing dividend recap loans being made, and for those of you who've not been exposed to those, that's where an investor makes his investments in a company, and the company goes and borrows money from a bank or a lender, and the money is used to repay the investor, and it's in the form of a dividend. The investor almost takes all of his own skin out of the game.
So, Mr. Moy, if I could just interrupt you there on those 2 points.
Yep.
Covenant light and dividend recaps.
Mm-hmm.
You've raised those as concerns, and I will rephrase them as risks, as risks that we should be sensitive to. What are you doing and the staff doing to address those?
In looking at the track records that managers are presenting, you always try and determine how they generated the track record they've got. And to the extent that it's been done by dividend recaps, or to the extent that it's done by other financing means, you try and isolate on that. The emphasis in private equity today is to have managers who bring something to the table and allow or assist their portfolio companies to grow earnings before interest, taxes, et cetera. So EBITDA is the term we use for that. So to the extent that there's an ability to grow a company is a far greater value than the ability to finance. Now, 15 years ago, finance was the way money was generated. Now it's how to help a company grow and increase its value. To the extent that once you make a commitment to a manager, and the way it's currently done in private equity, you typically don't place limitations on a manager in terms of how they finance an activity. They are all looking for covenant-light loans. They're all looking for dividend recaps because they are trying to get their money back out. So it's an issue of if you're a buyer or a seller. You happen to be both. So to the extent you have portfolio companies that a manager's trying to sell off to third parties or to a strategic buyer, the ability to do that financing advantages the purchaser and you, the seller. So it's a mixed blessing. I don't think, and I haven't seen or heard any restrictions trying to be placed on managers with respect to those, you call them risks, I call them, let's call them characteristics that are in the marketplace that are kind of baffling. It certainly does become a risk when it's put onto a company that doesn't have the strength to sustain itself with that type of leverage placed on it.
Okay.
You were going to have
No,
follow-on?
I would just, it's the track record.
The track record from history. Going forward, when you're trying to manage risk, you're trying to be prospective. And the ability to restrict a manager from taking advantage of what's going on in the credit markets it just isn't done right now.
So I interrupted Mr. Moy's presentation. There are two other board members who have comments. If they're on this issue,
Please.
that would be
Even
fine.
if they're not.
If not, I'd like for Mr. Moy to finish. Is it on the issue?
Yeah.
Okay. So, Ms. Rogers.
Mike, when you're saying covenant light, great phrase, covenant light, whether it is in your world or some of the other ones we've touched on, is this stuff being securitized and resold, or is somebody holding it?
Typically not. Covenant light, most loan agreements that are placed on portfolio companies have, let's call them covenant restrictions in terms of maintenance of working capital, maintenance of EBITDA, a certain level. You know, they have all kinds of financial. So when we talk about covenant light, those kinds of restrictions don't exist, or they're at a de minimis level.
When we're saying risk, I think going to Harry's point, what is motivating a lender that's just been beaten up to create a covenant light? I mean, are they trying to kick the can down the road themselves of some sort? I mean, they've got companies they don't want to write off, or are you really back into some kind of a game? And why I was saying the resales, anytime you resell it and you make a fee, you know, you get something out of it. Where is the danger? I mean, the danger is in the motivation in this, and what's the motivation for it?
The danger may not be in the private equity portfolio. It may be in your bank stocks
That's
or
what I'm
something.
asking.
Right.
You know, I think
That's where the
this is all
danger might
feeding
be.
up, back upstream
Yeah.
to blowing up the financial institutions again.
And the motivation for the resumption of practices, which I think most people believe got us in trouble during the crisis, the only thing I can come up with is that the compensation systems that are used to manage and run these institutions are, you know, encouraging people to place those kinds of loans, to do the kinds of underwritings that we look at and just are aghast. And there's no regulatory restriction. Once one banker does it, the others, to be competitive, are going to do it. I mean, it's
But
just.
they're keeping these loans on their books even though they're flaky?
Well, you call them flaky. They would argue that they look at them in their A credits. They don't have to have these kinds of restrictions. They would argue that kind of credit is different. So
somebody's making their loan formation goal for the year by doing it, or some such thing?
that's my
That's your-
analysis.
that's your
Yeah,
take on
right.
it.
That's my
Okay.
analysis. Yeah.
Their loan volume for the year.
Ms. Widener?
So this is a common business model in private equity. The company, the firm takes our money and goes to the bank and borrows more money, right? And against, and dumps the debt on the company they buy. That's what this model is, right? So what-
Varying degrees.
Yeah.
Yes.
So what are you, I don't understand the difference between the usual business practice and this risk you're discussing. What number, what amount of money, what percentage of debt on a company, what's different or unusual about?
Let me try and answer that, because it's a rather elaborate answer. Different sectors use different forms of finance to finance their business. Some business sectors are heavily equity financed. Others are a mixture of equity and debt.
Well, let's talk about we're talking about the sector.
The sectors,
What
yeah, right.
the sector of
Sex-
the company
the,
is.
the sector, a
Health
company in the retail
versus-
business
health
might have
versus-
an 80-20. A company that's doing a utility might be heavily leveraged. I mean, so each sector has their conventional finance methodologies.
Okay.
And in the private equity space, it's founded on the premise that it's going to do acquisitions. So when you do an acquisition, you finance it, some equity, some debt. And it depends on the industry
The
it's
equity
in.
is our money.
And the issue used to be, it was far more debt than equity. And as long as things were going up, returns were great. But that cycle turned, and it's became much more of an equity play. So it was 50-50. And it's starting to go back in the other direction, where there's more and more debt being laid onto these transactions.
How long did the 50-50 period last?
I'm gonna say 12 to 24 months. And it was really cycle dependent. It's cyclical. And that is just part of the business cycle. Okay. Looking at your portfolio, a couple of issues that you should just be aware of. You have a tilt in the portfolio towards the large mega buyout space. It's kind of like 60 to 70% of your portfolio, and that's a historical number. And it's the large public pension plans who are investors in private equity. They all have a similar tilt in that direction. And the reason for that tilt is primarily because it enabled you to deploy lots of money into a space that would otherwise you couldn't do it. So, and the performance levels on the larger buyouts historically have been better than most. So you had a high performance and an ability to deploy a lot of money, so you put a lot of money into that space. So when you look at portfolios, you need to understand how much of it's buyout and how much of it is not buyout.
So before you
Wait,
continue,
no,
before you
let him
continue,
go.
Mr. Moy.
Let him go.
Okay.
I want to ask a question
Okay.
when he finishes.
Now, if you went back and looked at your portfolio at the beginning of the program back in the 80s, you had a much higher tilt towards venture capital. Venture capital at that time was a much more robust location for investment. Since that time period, we've gone through a number of bubbles, and currently venture capital is a very difficult market for a large public pension fund investor to access for two reasons primarily. One is most of the managers do not want to be subject to the FOIA, the Freedom of Information Act requirements that you all are subject to. So they are afraid that information that's proprietary to them will become available to the public, and they're paranoid about that. But the second problem that a big investor has is most managers in the venture capital space cannot manage capital at an extreme level. They typically will find an entrepreneur and they will set up an investment that has a series of milestones, and the capital will be fed out in relatively small bite sizes. You won't write a $100 million check to an entrepreneur. You might write a $5 million check and then a $15 million check, and at the end you might have a $20 million commitment to an investment. And that might take 4 or 5 years. Whereas in a buyout, you might have a transaction that's several $100 million and capital can get deployed. So the managers are unable to accept large checks, and because you can't write large checks, you typically don't get access. So your portfolio doesn't have the same venture concentration that you might find in much smaller investors. We had this discussion at the workshop about terms and conditions because there's been a lot of publicity over the effort by the industry, the limited partners, to improve the terms and conditions. We still are seeing pressure being brought to bear on managers when they're in the marketplace to improve the terms and conditions that they're offering to investors. It's going to take a long time for this to work its way through your portfolio, just because of the life cycle of a commitment to a manager. But we are seeing a lowering of the management fees. We are seeing improvement in the sharing of other fees that the managers might generate during the life cycle of a partnership. So we are seeing a number of things that are improving. The pendulum has swung in the direction of the limited partners. It used to be in the direction of the general partners. It is now swung over. Whether it's going to resume or not, I'll tell you that 2 more reports probably, because 2011 is going to be an interesting year to see what the commitment level is, to see what the activity level is, and to the extent that it starts to be very active and very aggressive, and we see positive signs, the pendulum could swing back again towards the general partner. But right now, it's kind of on the limited partner side. And then the last comment I have would be on the proactive portfolio. The improvement there on it, we only report improvement on that on a since inception basis, and from 6 months ago to this time period, the improvement is 110 basis points better than it was back then. But on an absolute basis, it still requires close monitoring and assistance from the staff. And I'd be happy to answer any questions.
Thank you very much, Mr. Moy. We have a couple of board members who are in line here for some questions. I would also, well, I won't remind the board of that. We'll just go to the next person in line to speak, and that is Ms. Widener, followed by Ms. Harris and then Ms. Rogers.
Thank you for the report, Mike. I think my question references page 211. I remember these mega buyout deals coming to us, and I remember the discussions of our concentration in buyouts and the extraordinary size of these funds. And, you know, we, in general, when we raise issues about that, we get told what you've told us about it used to be venture capital and now it's buyout, so that's that. And we get told that we invest with the top 25% and they're the people that have the great returns and everybody else is a crapshoot. So and we get told it's great for us to have one place to stick all the money. It's difficult when we have to give out tiny checks of $20 million. So now here are those large mega buyout firms not doing as well as we expected. So how should we feel about all this going forward? Should we be concerned that perhaps having this kind of concentration is not, if it's not going to earn the returns, then just because it's an easy thing to do with that much money, how should we feel about this?
Well, the fact is that to the extent that you're still in the commitment period with some of the mega buyout players, you are paying management fees on the committed amount.
Yeah, on that,
okay.
on that only amount.
But from the perspective of making new investments, which they're all out looking to do new investments.
That's right.
They're all migrating to where the investments are. So I think we're going to be witnessing migration down to a level that's not mega. It's going to be large buyout space. And we have seen some managers reduce their commitment levels because of their feeling that they can't deploy the money. And, you know, we're seeing mixed signals out there in the marketplace. To the extent that there's an, let's call it a space between managers who've given back commitments or reduced their commitments levels to others who are trying to do transactions, I can't answer for the in-between. The only recourse technically that you would have is, when they come back to seek another commitment, which they all will do at some point in time, because that's the way the cycle works in private equity. That's when you get your payback.
Mr. Elman,
Fine.
sure.
And I think, part of the comment is the media portrays buyout funds as evil, bad, malicious. And I'm not going to defend them, but I would encourage you to turn to page INV 219 so we can look at the facts. And as Mike said, you need to focus in on the longer-term performance. So look at really the 10-year performance of the various groups. You can compare our return and then what the benchmark return was. So the benchmark return is kind of like what I would call the honor roll. It is a measure of only the funds that were funded, not the ones that didn't get funding. But there you can see the returns of U.S. international buyouts, but particularly venture capital and even expansion capital as being fairly problematic areas over this last 10-year period. We hear a lot in venture capital about the Facebooks and the Amazons and, the exciting stories, social media stories. But they have still been very difficult places to generate returns. Now, going forward in the next 10 years, that may not be true, and the staff is eager to try and find those opportunities. But despite the media's descriptions, those are the actual returns of the industry and our actual returns in those subsectors over the last 10-year period. You can also see the since inception returns, which, as pointed out, that goes all the way back to actually the early 90s for us, so it picks up another time period.
Ms. Harris, you're next.
I just wanted to sort of jump in at this point and express my gratitude, and I would assume of the other board members, for the role that you, Mike, Chris, at the helm, Jack, but our staff, what you have done to help to educate us in the area of private equity, and how much more meaningful it was for me to read this after our wonderful education presentation that we had in March.
I think staff really deserves the compliments on that. I play a real minor role.
But we know we have a wonderful staff. Thank you all.
Ms. Rogers.
Mike, you mentioned very briefly the emergence of a secondary market in these positions. Is it robust enough that we've ever bought anything or plan to sell anything into it?
Yes, it's robust enough. I think it was announced in the paper yesterday. Your fund across the river sold $800 million worth, and I know they sold a couple of $1 billion back in 2007. So it's a pretty large market. You'd have to ask staff about the plans about accessing it, and my guess is they'd be more than happy to talk about it in closed session.
Any other board members, questions or comments for Mr. Moy? Okay, seeing none, thank you very much, Mr. Moy. Appreciate it.